Hey, you there. We know you're working hard, guiding those you serve through changing regulations, evolving business models, getting in front of changing global forces, adopting new technologies at unprecedented speed. Confidence, drive, intuition. You have what it takes to lead.
If I'm to be an effective leader, I need to be always up to date. I need to be rounded up in terms of my emotional intelligence.
Curiosity helps me to broaden my knowledge. I'm used to things changing in terms of my subject matter, and that's why I always try to adapt myself.
For me, I have to demonstrate integrity, transparency, and accountability in handling honest financial matters.
Your superpower? A strategic mindset.
I'm passionate about making a difference. I'm very open to change, and if anything, I like driving it.
We need to give the space the others to say what they need to say, and also to give them the space to understand, because sometimes the words are different, sometimes the meanings are different.
During times of challenges, we tend to stick to what we know best, but do not forget that it is also during these challenging times that we should think innovatively to find new solutions.
You are a problem solver, data specialist, and a mastermind. Your ideas and initiatives drive change and growth. The future of the profession is bright because of those who rise to lead in their own way.
I try to use tools which will help me get my output faster rather than only drawing intelligence from that output.
Advocacy, guidance, resources, serving the public interest, creating opportunity, helping you accelerate and then lead.
I think the next generation has got this wide open world in which they can develop.
Being a member of SEMA has really made me realize that I'm a visionary, because you go through articles that are talking about the future, and I see myself fitting in the equation.
What will be your role in the future of our profession?
Good afternoon. You're all very welcome to today's webinar, IFRS Update. You will see the Q&A button on the bottom of your screens, and as all attendees will remain on mute for the duration of the webinar, you're welcome to input your questions here and Robert will answer them at the end of the webinar. We will be recording this webinar and will provide you with the link via email later this afternoon. We're delighted to welcome back Robert Kirk. As most of you will know, Robert is Emeritus Professor of Financial Reporting in the Ulster University. Robert has been a committee member of the ICAI's Accounting Committee that advised the ICAI on promulgation of accounting standards. He's an author of 3 recent books on both national and international financial reporting standards and over 120 professional journal articles. Robert is a regular speaker on accounting standards in the UK for SEMA and has presented for many companies in-house, both in Ireland and in the UK. So I'll hand you over now and leave you in Robert's capable hands. Welcome, Robert.
Thanks, Jean, and welcome everybody to this IFRS update, which will take approximately just 1 hour. There's a lot happening in international accounting, and so I'll only be able to give you a flavour of the major changes that have taken place over the last 12 months or so. What I'm going to do is talk about IFRS 18, which is probably the biggest change, although it's not coming in for a couple of years yet, but you need to get yourselves ready for it. And that's presentation disclosure in financial statements. It was announced in April. That will replace the old standard IAS 1, the very first international standard. Then we have IFRS 19, which from an Irish perspective probably isn't as important as it would be in other countries of the world. That's because we have a standard called FRS 101, which is designed for subsidiaries of listed companies. But that's not the case, of course, in the rest of the world. So they've introduced a new standard on disclosure for subsidiaries without public accountability. So I don't want to spend too long on that one. Then we move on to a particular amendment to the cash flow standard, IAS 7, on supplier finance arrangements, which actually came in this year. So for all of you preparing your accounts for December 2024, you have to be able to apply that now, this year. And to finish off, briefly, we will be looking at the output from the Financial Reporting Council and also the Irish Accounting and Auditing Supervisor Authority, particularly the latter, because they are obviously very important for all Irish listed companies to make sure you're aware of the kind of issues which IAASA will be examining for the years ending 31st of December once they're published. So without any more ado, let's have a look at IFRS 18, which is called Presentation and Disclosure of Financial Statements. It was a long process to come from the exposure draft to the final stages. That doesn't indicate its difficulty. It's simply because COVID was in the middle of all this, and there are a few other issues that had to be sorted out in the meantime. So it's kind of lost its priority. And I have to say that you are allowed to implement this early, although you don't have to implement until 2027. It's actually quite easy, I think, to implement. It's not revolutionary, not certainly in the way that the leasing standard was that was brought in a couple of years back. So the deadline anyway will be for accounting periods beginning on or after the 1st of January 2027. As I say, I can see many Irish companies implementing this earlier than that. Maybe not for 2024, but certainly for 25 or 26. And in the year in which you do apply this particular new standard, you have to also apply it to the interim financial statements in the initial year of application. And that means you have to restate your comparative figures. It's not difficult to restate, and that's why there's no real transitional relief. Now, in summary, you'll see in dark blue the major changes that are taking place to the profit and loss account and the layout and presentation of the profit and loss account, and also to the notes which back on to the financial statements. That's where the major changes have taken place. There are also some minor changes taking place to the statement of cash flows, and really minimal changes taking place to the other documents. Really, it's all about crossing the T's and dotting the I's. There's nothing of any import at all going in to the balance sheet or statement of financial position or comprehensive income or changes in statement of equity. The first change that they brought in the main change, paragraphs 41 to 43 of the new standard, was all about trying to help you understand better when those circumstances, when you should aggregate, and those circumstances when you should disaggregate information, either in the primary statements or in the notes. And the principles, I have to say, are a bit wishy-washy. They're basically saying, look, if it's material, then, and it's likely to affect users' decisions, then, and it doesn't, you should disclose it. If it's likely to obscure important information, you should disaggregate. So, if you can add things together which are not going to harm the decision's usefulness process, no problem, but you must disaggregate, as I say, if you believe you're obscuring information which is of use. But it's that kind of waffly language which is in here. I suppose the major change that is happening, however, and we'll see this in a minute or two, is that you will no longer have to choose between analyzing your operating expenses by nature or by function. That has now gone away with, or will be gone away with, and now you can use a mixture of the two. So you can choose what is best for your company. Should I take, say, selling expenses and break it down by nature, or should I simply leave it by function? So I will see examples of this in a minute or two. That's just going back to what I was saying there on the principles of grouping. And there it is at the very bottom. So the principles generally require companies to aggregate items that share characteristics and disaggregate items that have different characteristics. Make sure you group items that does not obscure material information or reduce the understandability of the information presented, and place items in the primary statements and the notes to fulfill their complementary roles. As I say, it is, wishy-washy there. Now, in terms of the statement of profit and loss, this is where there are big changes. You now will have to classify from 2027 your income and expenses into 3 defined categories, and we'll see that on the right-hand side in the next slide. In addition to that, you're going to have to present 2 compulsory subtotals between these categories, and that we'll see on the left-hand side of the slide. Now, looking at the right-hand side, in red, you'll see the headings operating, investing, and financing. And that is actually very similar to the way we break up the cash flow statement, if you think about it. We break up our cash flows along those lines. So in many ways, it's kind of bringing the profit and loss account into line with the cash flow statement. We'll talk about what goes into each of the categories in a minute or two. If we also look on the left-hand side, you'll see that you have 2 compulsory subheadings. One is operating profit, which is supposedly to give you a complete picture of the company's main operating activities. And then profit before financing and income tax is to give a picture of the company's performance before you bring into account the impact of financing. Now, it is possible for you to bring in other subheadings. I mean, gross profit is not official, but most people bring it in because it's part of the legislation as well. And also you find some people will bring in operating profit after associates' share of associates' profit and joint ventures profit and things like that. So you will be able to bring in additional subtotals if you wish, but those are the 2 brand new ones that must be compulsory brought into the financial statements. Looking at the actual statement itself, you will notice that there's a mixture of nature and function. So I would argue cost of goods sold and selling expenses and general admin is basically a functional heading, whereas I would argue research and development expenses and goodwill impairment losses and possibly other operating expenses are really nature of expenses. So that's just my point is you can now use whatever mixture you feel is most appropriate to your company. Now, as regards to the operating category, it is supposed to include the income and expenses from the company's main business activities. It's also a default category. So if you can't fit it into the other 2 categories, then you must put it into the operating category. In terms of the investing category, it's fairly straightforward. It's income and expenses from assets that generate a return individually that are largely independent of other resources held by the company. So rental income, remeasurements of investment property, interest income, fair value changes in financial assets, dividends and fair value changes in non-consolidated equity investments. Those are the kind of things that go in, as well as income from non-consolidated subsidiaries, associates and joint ventures, and also income expenses from cash and cash equivalent. There are some specifics, however, when you're dealing with entities with specific main business activities, and you may well have to classify in investing if you're applying the equity method and not in operating if you're not applying the equity method. I'm not going to go into that at this stage, but there are some specialist rules for specified business activities. In the financing one, you bring in the raising of finance, basically through shares, repayment and raising of debt, including bank loans, and obviously things that like leasing, anything to do with leasing, and also pension schemes are also brought in there as a part of the financing category. For some specialist companies, and one can think of banks and insurance, of course, their main business activity is lending money in the case of banks and bringing in insurance income for insurance companies. So that should really obviously go into the operating category. Whereas in other situations, other companies would probably go into investing or financing. So you need to make sure that if you have a specified type of company like that, it makes sense where you put the particular income and expenses. Now, in terms of operating, as I've said, you have a choice between nature and function. You can pick and choose bits and pieces of both of them. The standard simply says you must classify the expenses in such a way that provides the most useful information to investors. You've got to think about what line items provide the most useful information and what line items most closely represent the way the company is managed. So it really should be through the eyes of management team. If, however, you do classify any of your expenses by function, then you do need to have a separate note to the accounts. And in that note to the accounts, you will have to set down 5 different types of nature of expenses: depreciation, amortization, employee benefits, impairment losses, and write-down of inventories. And you'll have to show exactly where they can be found within the profit and loss account. We'll see an example of that in a minute or two. But before we do that, I should also point out that some of these items may well be capitalized, and they would also be disclosed in there as well. And they would probably need some form of qualitative explanation if part of that amount that's disclosed has actually been capitalized in the carrying amount of the assets. Now, here's the example that they provide. You'll see that research and development expenses is included. It's partly in depreciation, it's partly in amortization, it's partly in employee benefits, and partly in impairment losses. So all you're doing is you're showing where these items are actually recorded in the financial statements. And I think that's a good thing. It means that the users will have a very good, clear indication of these total amounts, which are hidden, if you like, within the body of the profit and loss account. So you can see the total of depreciation quite clearly in the note, even though you don't get it on the profit and loss account itself. So that is a single note that you would have to provide on expenses by nature if you're putting them in functional headings. The standard in the examples that they provide do give you a couple of very useful examples on this particular topic. This particular company has got 2 performance statements, a profit and loss account and other statement of comprehensive income. And if we go down that, they're also decided to structure their expenses in the way which they believe best meets their way the business is managed. So they're using a mixture of function and nature. And they say this is the way that management reports internally, and is also standard practice within the industry. They've also decided that goodwill impairment losses should be shown separately, because any allocation to the functional line would be totally arbitrary and would not be a faithful representation. There's the example that they give you. Notice that you have the 2 new compulsory headings coming in there: operating profit and profit before financing and tax. But you'll also see gross profit, you'll also see profit before tax, and you'll see profit from continuing operations, which are additional subheadings that they've decided to bring in to the statement of profit or loss. The second example is a manufacturer. Now, this particular manufacturer, in fact, is not just manufacturing goods and selling them to their customers, they're also providing finance to their customers as a main business activity. And that means it goes in to the operating part of their statement of profit and loss account. Again, they've decided to analyze their expenses by a mixture of function and nature. That's the main thing. So I'm just going to quickly run through it. You'll see there that they brought in a gross profit from the sale of goods, and then underneath that is your interest revenue related to providing financing to customers, and the interest expenses and so on. And that's all included within the figure of operating profit there. They've also brought in another subheading there called net interest income. So that's there's the backup note for that, by the way. It's very similar to the one I've just shown you. The third big area that they're changing is the area of management-defined performance measures. Now, listed companies, many of them, in fact, nearly all of them, to be honest, have been producing these alternative measures of performance, APMs as they're often referred to. And ESME, that is the European Securities Market Association, have issued guidelines on how those should be presented in the financial statements. But it's not a part of a standard or anything like that. They're guidelines. And I know IAASA has been very hot in making sure that Irish companies do comply with those guidelines. But the problem about the situation as we find it at the moment is that investors do find the measures useful, yes, but they're very, very concerned about the quality of the disclosures that they're provided on these particular measures. It's very difficult to find out exactly how they're measured. It's difficult to find out why did you actually choose these particular ones to assess manage or your company's performance. In many cases, they aren't reconciled back to the official figures produced by the IFRS standards, and often there's no discussion there of the impact on tax and non-controlling interests. So what they've decided to do is to bring in a definition of management-defined performance measures, which will be known as MPMs. And the definition is down below there. They are subtotals of income and expenses other than those listed by IFRS 18 or specifically required by IFRS accounting standards that a company has used in public communications outside the financial statements in order to communicate to investors their overall view of an aspect of the company's performance. So that's what an MPM is. And they should all be put together in a single note to the financial statements. So it's all about increasing the transparency and investors' understanding of how the measures compare with the measures that are in the accounting standards. That's what they're really trying to achieve in these MPMs. Now, it's interesting, when you look at the items that will be included as MPMs, it's not crystal clear. If the information is a subtotal which is already required by IFRS, they're definitely not included. And that's basically the ones in the middle there. And things which are not netting off income and expenses, such as free cash flow, return on equity, and so on, they are not regarded as other performance measures either. So you're a little bit restricted in what exactly is an MPM. The examples that they've given there is adjusted profit, adjusted operating profit, adjusted earnings before interest, tax, depreciation, and amortization. There is a document which is basically published in their basic conclusions as a flowchart, which you can go down through step by step and see, in fact, do you think it actually meets the definition of an MPM? And the other problem is, I think there is a conflict between the ESMA guidelines and what they're now introducing in the MPMs. And hopefully that conflict will actually be sorted out over the next couple of years, maybe by an alteration in the guidelines. The following are definitely excluded. Gross profit is, and then operating profit or loss before depreciation, amortization, and impairment. Operating profit or loss and income expenses from the equity method investments, profit or loss before tax, and profit or loss from continuing operations. These are all specifically excluded in paragraph 118. So it's not as straightforward as you might think as to what exactly is defined as an MPM. There's the actual diagram itself to try and help you decide whether you have got an MPM or not. So you can see that it has to be a subtotal of income expenses. It has to be used in public communications. It cannot be specifically excluded, as we've just seen in the previous slide, by the standard itself, or it's already disclosed, required by another international standard. And it has to give management's view of an aspect of performance. So when you go down all of that, you're kind of restricting yourself to quite a small number, I think, of what we would originally call APMs and now called management performance measures. So anyway, that's one of the big changes there. What do you have to disclose? You've got to disclose sufficient information so that the user can understand basically an aspect of performance from the viewpoint of the management team. and make sure that they can understand how it fits in with other IFRS measures. As I said, it should be in a single note, and make it clear that it's your own specific measure. It's not comparable with other companies. They may have similar labels, but they may not be calculated in the same way. So you cannot really compare any MPM in an individual company with another company. It's also important that the MPM should be labeled and described in a clear and understandable manner. Okay, that's the disclosure which is required. There's a reconciliation back to the official figures. There's need to be a description of why you think it communicates, or sorry, how the measure communicates management's view. If you do change any of the MPMs, you give an explanation of that. A statement that the measure reflects management's view of an aspect of performance, and it's not necessarily comparable to measures sharing similar labels or descriptions. So that's basically the MPMs. There's the example that they provide in their there's 3 books altogether for IFRS 18, the standard, the basic conclusion, and examples, and this is one of the examples that they provide there, showing the move from the official operating profit figure right over to the MPM on the right hand side there, and then a nice narrative explanation of the 3 adjustments that have been made to arrive at the MPM. And that's been done, of course, not just for the current year, but also for the previous year as well. There are some paragraphs on capital. Not that these are new, but it's very important that the entity discloses sufficient information in the notes so that users can understand and evaluate the company's objectives and policies for managing their capital. That should be both in qualitative terms and also in quantitative terms in summary. And any changes that happen during the course of the year. So you need to give a description of what it manages capital, what's when it's subject to externally imposed capital requirements, their nature and how they're incorporated into the management of capital, and how it's meeting its objectives. You should also talk about whether you've complied with any external imposed capital requirements, and if that's not the case, the consequences. So those are the changes to the old standard IS1. But in addition to that, there are also amendments to IS7. And there are 2 major amendments here to the cash flow statement. First of all, I'm delighted to say that we are now going to get some consistency in how we calculate the operating cash flows. Up until now, there was no right or wrong starting point for the figure for profit. There were different starting points that people tended to use. Now you're going to have to pick up that subtotal, that new compulsory subtotal called operating profit or loss, and that's going to be your basis for starting to produce the indirect method. Obviously, you're going to have to add back your depreciation, amortization, etc., etc. But it's good to have a similar starting point for the first time. The second major change is that they've now decided that the flexibility, which is currently there in relation to interest and dividends, should be removed, and that for the majority of companies, interest received should be always put into investing activities, interest paid should always be in financing, dividends received always into investing, and dividends paid in financing. In the past, you had at least an option, maybe in fact in some cases 3. It could go into investing, financing, or operating in some cases. Now, those entities with specific business activities, and we're talking here mainly about the banks and insurance companies again, because their interest is their main activity, you would expect to see both interest received and paid included within their operating activities as a single category, and dividends received again possibly in the same as well. The only one that would go into financing would be the dividends paid. So the 2 major changes they're making there are really, to me, tidying up exercise. There are some minor changes to the earnings per share figure, but it's nothing really of concern there. And there's also some minor changes to the IS34. The standard doesn't actually affect interim reporting, but it has been amended to require companies to disclose information about the MPMs in their interim financial statements, which perhaps they haven't been putting in their APMs there, though I think probably they have been up to now. So there are some side effects there really coming into earnings per share and interim financial reporting. So to me, that's the most important of the changes that are taking place. But as I say, it doesn't come in until 2027. And I can see that some companies, more progressive companies, will think seriously about implementing this fairly early. Now, I don't know if there's any questions, but certainly in the chat box or in the question and answers. Yes, I see there's a couple there. The anonymous attendee saying, are these standards to the UK as well as, or just Ireland? Well, no, it's for the world actually. So it's every country in the world. For anybody, a company which is quoted on a stock exchange, basically. That's who have to apply international standards. So yes, it applies for the UK as well as Ireland. And the other one is relating to IFRS 18, would fair value gains and losses on financial instruments be presented in the operating or investing category? I would argue that definitely goes into investing, because that wouldn't be regarded certainly as your main activity. That might be different from the point of view of bankings. I think banking may be in operating, but certainly in terms of the normal company outside financial institutions, I think it's definitely going into investing activities. Okay, so that's the two there. Now I'll quickly move on, if I may, to the next topic. Before that, that's just summarizing the changes there. IS1 disappears in 2027. The new standard is incorporating lots and lots of things that I haven't talked about today, which is already there. And then the changes, of course, to the P&L, etc. So I've only covered the changes there, but a lot of the old standard would be retained. And that's why the new IFRS 18 is a mixture of the amendments and some of the rules in the old standard. For example, there's no change to the layout of the balance sheet, no change to the statement of changes in equity, no change to the statement of comprehensive income. IAASA, by the way, has announced, they very rarely have done this, but in September they issued a document as guidance on how you should implement this new standard. And they say this is an ideal opportunity for companies to have a conversation looking at how they present their financial statements that best meets the information needs of a wide range of users in making economic decisions. And then if you go down to the second bullet point, it talks about relegation of exceptional items to the notes might in some cases reduce the risk of obscuring important information by reducing clutter in the income statement. So that's interesting that exceptional items, they're almost saying, well, should they really be on the P&L account at all? Or should they just be disclosed in the notes? And then they also talk about materiality. You've got to think more about that, the opportunity to explicitly consider materiality in the preparation of the financial statements and consider providing explicit disclosures basically on how you build up your thresholds. I mean, how do you determine your quantitative thresholds when you're talking about materiality and disclose those thresholds? They also, again, repeating themselves again, talk about these exceptional items. They suggest there might be, you might consider adopting a hierarchy under which exceptional items prioritized those that might still stay on the profit and loss account and those that only goes into the notes. So you really should rethink your exceptional items. And then they seem to be very anti the columnar approach. They think that introduces a plethora of earnings measures and they're very difficult for users to understand. It wouldn't be my view. I think columnar approach is quite useful, but there certainly seem to be suggesting that maybe that's not the right way to go, looking at, in between the lines there. Anyway. And then MPMs, they recognize that there are conflicts there between the ESMA guidelines and also what's required for the MPMs. But anyway, regardless of that, you should consider how the different requirements should be met while providing useful, relevant, and reliable information to users. That's the guidance that they have issued there in September on how to implement the new standard. Now, I said I only spent a couple of seconds on this one. This is IFRS 19, subsidiaries without public accountability disclosure, came out in May. The problem really arose because if a parent is preparing its financial statements under full IFRS, that is not necessarily what the subsidiary will do. The subsidiary will prepare their accounts using local GAAP or maybe the IFRS for SMEs, or they can apply full international standards if they wish, but that results in a huge amount of disclosure, which is disproportionate for those subsidiaries. So it's not ideal that there isn't a full link, if you like, between the subsidiary and the parent. No matter what happens, the subsidiary has to submit consolidation detail by applying the full IFRS accounting standards. So how do you solve this problem of maybe overkill in the financial statements of the subsidiary? Well, the solution has been that the subsidiary would actually prepare their accounts under full international standards, but only for recognition, measurement, and presentation, not for disclosure. All their disclosure would be governed by a completely separate standard, which would be called IFRS 19. And that would be, the detail in that standard is way, way below the disclosure which is required by full international standards. Now, in a sense, we have already got that in Britain and Ireland because we have IFRS 101, which actually does the same job. So that's why I can't see it being overly applied in Ireland. But it may well be that if it's a company maybe in Australia or New Zealand or something like that, and they've got subsidiaries all over the world, then they may require their Irish subsidiary to come into line and prepare their accounts using IFRS 19 rather than IFRS 101. Now, the only people who can apply IFRS 19 are so-called eligible subsidiaries, and these are subsidiaries that do not have public accountability. That means they have no debt or equity quoted in the market, or they're not holding assets in a fiduciary capacity like a bank or a credit union or insurance company. And as well as that, its ultimate or any intermediate parent must be producing their consolidated accounts under international standards. So that's the people who can apply. You don't have to apply it, of course. It is a voluntary standard. It's one of the only voluntary standard there is really. So that's then just repeating what public accountability is. And I've already covered that. Just making sure you're clear on that one. The way that it's done and how you'd apply it, let's say you're looking at inventory. If you're looking at inventory, you would look at IAS 2, the standard on inventory in the subsidiary, and you would recognize, measure, and present according to the rules and regulations in IAS 2. But you don't apply the disclosure requirements in IAS 2. Instead, you switch over to the disclosure in IFRS 19. And every standard is in IFRS 19, and it tells you what needs to be disclosed for subsidiaries in that situation. You will have to state that you're complying with IFRS 19. So that has to be clearly asserted in your financial statements. Now, how did they come about it? Well, the actual disclosure requirements that are in IFRS 19 are a reduced version of those which are in other IFRS standards. Clearly, a very substantial reduction in disclosure. And to be honest, they're pretty close to the disclosure requirements which are in the IFRS for SMEs. They have a number of principles that they adopted in reducing disclosure. One principle, they said that, look, anything to do with going concern, we've got to be very careful here that we don't remove very important disclosure in those circumstances. So we still have to have information about the entity's ability to generate cash flows and continue as a going concern. And the ability to meet their short-term obligations. So that's important. Measurement uncertainty was important. So there are a number of things that they had in the back of their mind when they were deciding what reduction disclosure is possible. Now, the IFRS 19 is going to be changed on a regular basis because as new standards come out, they're going to have to change IFRS 19 in line. And already that's going to happen. There's already been an exposure draft since the standard has actually been applied. And in fact, that came out in July. Because when IFRS 19 was being drafted, it was only covering the standards that were put into practice up to 2021. It has not dealt with the standards from 21 onwards. So the exposure draft is bringing all of these into play, and that will be changed presumably next year in next year's version of IFRS 19. And it's covering things like IFRS 18, for example, is not in the current 19. Supplier finance arrangements, international tax reform and Pillar 2 model rules, lack of exchangeability. They're all not included, but they will be. One area that they've decided that they're not going to bring any reduction in disclosure is the amendments to the classification and measurement of financial instruments. And nothing is proposed for the new standard, which hasn't come out yet, on regular assets and regular liabilities. So that's the point, just to keep in mind that you're almost going to have a fresh copy of IFRS 19 every year if you want to apply IFRS 19. So I don't know if there's any questions on that one. As I say, I don't think that is by any means as important as IFRS 18. Don't see, and let's see, here we have it. One, I think.
No, that's fine, Robert. It's just asking for a copy of your presentation, but I can share that afterwards, no bother.
Right, okay. Thanks, Jean. Right, the third area, big area I just want to talk about is supplier finance arrangements. And this is the one that was announced last May, but it's coming in pretty quickly, coming in for years commencing 1st of January 2024. That means December the 31st this year. In other words, in 6 weeks' time, you have to implement this particular standard. Now, it's mainly an amendment to the cash flow standard, IS7, but there is some extra disclosure in the financial instrument disclosure standard, IFRS 7. The best way to look at this, if I get the slide down anyway, is the diagram. What is exactly, or what are supplier finance arrangements? Well, in step one, a company decides to buy in goods from or services from its supplier. Now, the supplier probably offers them 30 or 40 days time to pay. Instead of paying the supplier, what the buyer will do, it will get its own financial institution to pay the supplier in accordance with the agreements. And then they will pay back their own financial institution maybe a month or two later. So in fact, what that does is allows the buying company to obtain increased credit, enhanced credit arrangements through their own financial institution, but based on the goods that they're buying from their supplier. And that's how it gets its name, supplier finance arrangements. The problem has been that there's virtually no disclosure required up to date about the extent to which these arrangements have been developed. And so the key changes are to make sure that there's sufficient information in the notes to the accounts so that people can understand to the extent that these have emerged in the company's financial statements. Now, they don't attempt to define exactly what supplier finance arrangements actually are. Instead, the amendments describe the characteristics of the arrangement that the entity is required to provide the information for. And the amendments note that the arrangements that are solely credit enhancements, in other words, the entity is asking the supplier to give them extra time to pay, that is not part of this. This has to be a financial institution paying the supplier on behalf of the buyer. Now, the two objectives are to make sure that in the notes, the users will have sufficient information to assess how these arrangements affect the entity's liabilities and cash flows, and to understand the impact of the arrangements on the entity's exposure to liquidity risk and how it might be affected if suddenly these arrangements were removed. Might put them into a more severe liquidity crisis, if you like, if they were suddenly removed. So the changes are to IAS 7, that's the cash flow standard, and you have to disclose the following. You got to disclose the terms and conditions of the supplier finance arrangements. You also have to reconcile the opening and closing balances of the amount which is outstanding, if you like, on these supplier finance arrangements. You have to state exactly to what extent the suppliers already received payment from the finance providers, and you also have to give details of the range of payment due dates, and also give comparable trade payables that are not part of a supplier finance arrangement. So quite a lot of detail there is required. You don't have to do it on individual arrangements. You can aggregate a number of them together as long as they're pretty similar to each other, and that should satisfy the information needs of users. So that's the main change. The main change is the disclosure requirements for supplier finance there to IAS 7. In addition, what they've done is they've added an extra example within the liquidity risk requirements of IFRS 7. So you can have a look at that, and that will give you a good example of how to apply these new rules, if you like. As I said, the application date is from accounts commencing on or after the 1st of January 2024. There is some transition relief, particularly in relation to comparative information and interim information. So that's the third of the topics. I didn't realize the extent that this had raised, but they've even brought this into the local standard IFRS 102. Is coming in a year before the rest of the amendments to IFRS 102, which shows you how important certainly the Financial Reporting Council in London think it is, and obviously the International Board feel that it's a growing area of finance. And as I say, I wasn't aware that this was a huge new development. Anyway, those are the three changes. I don't know if there's anything there. No. So we'll move on then to the IAASA. Now, there is one quite important decision that came out in May from IAASA, and that's in relation to the hotel, the largest hotel chain in Ireland, the Dalata Hotel Group PLC. And it's in relation to how the company was applying the rules in the new standard on revenue called IFRS 15. Now, it was going back to the 2022 financial statements. What Dalata did, they included the proceeds from the sale of residential units as part of their revenue and as part of their continuing operating activities. And the costs which were related to those residential units were included within cost of sales. Both the proceeds and the costs were disclosed as a note on the face of the income statement. Now, when you looked at the accounting policy for Dalata on revenue, they described their primary activity as the provision of hotel accommodation and the provision of food and beverage services. At no time did they say that one of their primary activities was the sale of residential units. So IAASA basically said, based on the specific facts and circumstances, including the company's definition of what are their primary activities, and the fact that they made no reference at all to residential development, and that was the first time they'd ever come in to the financial statements, then clearly their view was that the sale of residential units was not part of the ordinary activities and therefore did not meet the definition of revenue under IFRS 15. So it's not part of their ordinary activity, and therefore did require to be separately identified, separately presented within the consolidated statement of profit and loss and other comprehensive income. So that was their conclusion to that particular one. But that kind of links in with what we're talking about IFRS 18. And I think companies are going to have to be very, very clear in what are their main business activities, because only what is a main business activity could be included, if you like, above the line. Anything below operating profit would have to be non-business main business activities. So I think there is a kind of link there between IFRS 18 and IFRS 15. The latter, however, have voluntarily agreed that when they're preparing their future financial statements, that they're not going to amend their description of primary activities in the director's report and include other activities that they consider to be part of their own activities, including those relating to development. And they've had to revise the presentation in the income statement, including the 2022 comparative amounts. So they're now disclosing income from residential development activities and the cost of those separately from revenue and cost of sales. Right, that's a case that came out in May. Now, in terms of the Financial Reporting Council, they every year produce their annual review, and they give you their top 10, the areas that they're most concerned about, or at least the issues that came up most. And it's very similar to Ireland in that the impairment of assets is the one that they're always concerned about in terms of how you actually go about calculating the impairment, particularly in the value and use calculations, because you've got an awful lot of assumptions about future cash flows, what discount rates to adopt to bring it back to present value and so on. So there's always causing problems. And then there's also the issue of goodwill and how you allocate goodwill into a cash generating unit. These are issues that are at the top of the tree, basically, that needs to be looked at. Then you have cash flow, which is surprising, and that's simply because maybe not so much in Ireland, but in the UK, there's been a failure to put the cash flows into the correct box, if you like. In some cash flows are going into operating when they're not operating, they're investing, and vice versa. So it's really the classification of the cash flows seems to be the major problem there. And then you have big problems when it comes to the application of the expected credit loss model. It's a very complicated loss model when you're dealing with financial instruments, and particularly when you're moving from stage 1 to stage 2 to stage 3. It's difficult to identify when those particular stages emerge. So those are the top 3, but there are lots of other issues there, as you can see, even including climate-related narrative reporting has just come into the top 10, and even the strategic report there, the management report, is in there as well. So it's a very useful document to look at. I would certainly recommend that you look at the website of the Financial Reporting Council and pick it out. I couldn't go through each of those individually, it just take too long to do that. But they're very, very clear, and the problems that they've faced and what you should be doing instead. Another topic that you might want to look at is that the FRC every year does release a number of publications on thematic reviews. And in 23-24, they brought out a paper on offsetting. Now, offsetting is not generally allowed in financial statements apart from areas like deferred tax, where the deferred tax asset and the deferred tax liability are to the same tax authority, and you intend to exercise the right of set off. And there must be a legal right of set off as well. But that's one of the very few circumstances where you can use offsetting. But what they've done is they've looked at that area very, very carefully, and there's kind of producing best practice examples there, which you can have a look at if you want to investigate that topic. Any of you in the insurance industry business, it's worthwhile looking at the thematic review on IFRS 17, because this is giving you good examples of what companies are disclosing in the first year of its operation. And then an area which is going to become more and more important in the financial statements, as well as in the separate sustainability reporting, is climate-related disclosures. And some companies are experimenting, I suppose if that's the right word, at this stage, and developing their ideas. And again, some of these best ideas have been brought into this thematic review as well. So it's well worthwhile having a look at that one, because I know that's an area which is becoming increasingly important for companies, making sure they do disclose sufficient information in their financial statements, as I say, as opposed to their sustainability report. Now, the final topic, just for a few minutes, is just to talk about the October 24 paper. It comes out every October. And IAASA say, this is what we want you to look at very carefully indeed, because that's what we're going to be examining when we're looking at 31st December year-end annual reports. And that's the list of them there, all the way down from sustainability to the identification of cash units. Now, if you look at those 10 topics, 3 of them are to do with impairment. I mean, number 5 is impairment. Number 8 is measuring value in use, which is really impairment. And number 10, the identification of cash units. They're all basically to do with impairment. So once again, highlighting that it's an equally important topic in Ireland. Now, I'm just going to go through the recommendations. It's very worth reading the report itself in full and what they found in the course of the last 12 months. But this is just simply quickly talking about matters that you should be considering when you're preparing your accounts for this year. So sustainability reporting, they're clearly saying that management should, and directors and audit committees, etc., should recognize the significance of sustainability reporting and the resources that are required to meet these new requirements, monitor the process of the entity and the processes used to identify information reported in accordance with the European sustainability reporting standards. So they're just highlighting sustainability. That's an area you've got to look at carefully. Personally, I think you really need a specialist team within these very large companies who would spend virtually 100% of their time in gathering the information which is going to be required under the CSRD directive. Now, accounting policies, always difficult here because you now have to disclose material accounting policies rather than significant accounting policies. And it's important that you understand the difference between estimates, accounting estimates, and accounting policies. Because changes in estimates basically go through profit, changes in policies normally go through prior year adjustments or certainly major changes in comparative figures. So it's very, very important that sufficient information is disclosed about these things that are very specific to the company, not generic, but very issuer specific and consistent with the information that's provided elsewhere within the financial statements and the management report. That's also a topic that's covered by the FRC as a key problem. Operating segments. What IAASA found out is that it's very unclear who makes the decision as to how resources are allocated across the various segments of the organization. This is supposed to be done by the CODM, but often that is not even mentioned. It's very difficult to say, who are these people? Is it the board directors? Is it the chief operating officer? Is it the chief financial executive? Who is it? Who performs that particular function? It's not clear. We need to spell that out. And we need to comply in full with the requirements in the disclosure element for segments. They're then warning people, when you're dealing with fair values, make sure that you are carefully evaluating. There's different valuation techniques to arrive at fair value. Some are market-based, some are cost-plus based, and so on. But it must be measured in accordance with IFRS 13. That's the standard on fair value measurement. So they're looking at that carefully. They're going to be looking at the disclosure on the impairment side. Well, we'll see they do the calculation later on, but the disclosure, there's quite a lot of disclosure required in terms of the assumptions used, in terms of your cash flows and so on. Contingent liabilities. They're saying there's a lot of investigations taking place by regulators at the moment, and it's very, very important that you disclose that fact, particularly if there's a possible obligation you're going to have to pay, and that is not remote. If it's a possible obligation that's not remote, you should mention that fact that you're under investigation by a regulator as a contingent liability. The management report is simply saying it should be a fair review of the development and performance of the business by expanding the report to include information again regarding these public regulatory investigations which may have an impact on the overall performance of the business. And that also suggests you could look very, very carefully at presentations, press releases, and other public announcements should be considered in deciding whether it should be included in the report or not. Value in use, that's the calculations. I've already mentioned this is a big area. Very, very important that the assumptions you're using are reasonable and supportable in arriving at your best estimate of the value in use at the end of the day. And be very careful when you're dealing with future cash flows, because they should not include any cash flows from future restructuring, nor of any attempt to enhance performance into the future. APMs, they're saying, please, at the moment, would you consider the ESMA guidelines and make sure you are actually complying with the ESMA guidelines. I realize that's going to change in the future, but at the moment you've got to comply with the ESMA guidelines for APMs. And then the last one is back to impairment again. And the important thing is that you should ensure that the appropriate number of CGUs are identified by identifying the cash inflows, which are largely independent of other cash flows within the organization. There's also a reminder to review the IFRIC agenda decision in 27 there. But to me, that's also part of the impairment issue. And so that really brings us right up to 2 o'clock, which is the finishing time. I'm not sure whether there are any, I don't see any, no other questions and answers, but if there are any, I'd be delighted to answer them if you have any in the last couple of seconds or two you have.
Yeah, I don't see any coming in. All right, Robert. So maybe just for the minute, oh no, there is one. Here is one. Oh no, just thank you very much. That's brilliant. Thank you, Mary. Yeah, if you don't mind, then just while we are waiting for replaced current. Sorry, wait till I just get my screen to be shared, please, if that's okay.
All right.
So while we are waiting, if there is any questions, we might just come to them at the end. But for the moment, if that's okay, Robert, thanks a million for your informative and detailed update. We really appreciate your expertise and time as usual. Before we do go, I'd like to draw your attention to our upcoming webinar on building relationships with communication and negotiation, which is scheduled for Thursday, the 5th of December. At 1 o'clock. So scan the QR code now there for registration. I'll send a link in the follow-up email as well. We hope you can all join us then. So let me just take one more time for questions. There isn't just at the moment. It must have been very comprehensive. Robert, thanks. Thank you all for attending. We hope you found it beneficial, and I'll send the recording on shortly. Thank you. Take care. Bye now.
Thanks, Jean.
Thanks, Robert.